Ratio analysis, MCQs. First question. Cash plus marketable securities divided by current liability is equal to quick ratio, acid test ratio, liquidity ratio, absolute cash ratio. LMR book, take your LMR book. Put proper effort and tell the answer. You know the answer, well and good. Else, you have to refer, underline panniko side by side, so that you have to complete the textbook also parallelly. Okay? So, assumption la solla kudadu. Inky pinky ponky ella monkey select panna kudadu. Seriya? So, what is the answer? Absolute cash ratio. So, what is the formula for absolute cash ratio? All of you? Cash plus marketable securities divided by, repeat one more time. So, by way of MCQ itself, you have to learn formula and what point wise, what answers also, you have to, descriptive answers also you have to learn. Okay. Second one. Price earning ratio is equal to EPS divided by MPS, MPS divided by EPS, earnings available to equity shareholders divided by MPS, none of the above. Only in examination hall, EPS divided by MPS or MPS divided by EPS are confused. So what is the answer? MPS, market price per share divided by earning per share. B is the correct answer. Good one. So repeat once again, what is the formula for price earning ratio? MPS, no, market price per share divided by earning per share. Next question. Return on capital employed. Return on capital employed is equal to EB80 divided by capital employed into 100. Profit after tax divided by capital employed into 100. Profit divided by investment into 100. So many problems we solved. EB80 divided by capital employed. Good. Return on asset is equal to, just now we solved the problem, right? Return on asset is equal to gross profit divided by total asset into 100, net profit divided by total asset into 100, EB80 divided by total asset into 100. Net profit divided by total asset into 100. Only if the net profit is not given, whatever the available profit you can take. Else, net profit is the correct answer. Next. Preference share capital plus debentures plus long-term loan divided by equity share capital plus reserves and surplus is equal to capital gearing ratio, proprietary ratio, debt to equity ratio. Assume பண்ணி சொல்லாத check பண்ணியே சொல். What is the answer? Capital gearing ratio is the correct answer. So repeat once again, what is the formula for capital gearing ratio? So numerator ella under denominator shareholders fund irukku, equity bonus fund. Numerator preference share capital, debentures, all other funds. So capital gearing, in which component it is there? Capital gearing ratio. Comfortable? If gross profit is not given, then we can consider purchase as a gross profit, net profit as a gross profit, EB80 as a gross profit. EB80 had assumed as a gross profit. This is a fundamental assumption to solve ratio analysis. If purchase is not given, we can consider EB80, cost of goods sold, or any one of the above. Cost of goods sold. EB80, when we have to consider? Gross profit is the EB80. Okay. Next. If the opening creditor is not given, then average creditor is half of the closing creditor, any one of the above. Closing creditor is itself average creditor. Good. Financial analysis can be horizontal, vertical, any one of the above. So all of the above. Answer is one, both horizontal and vertical. Next. If financial statement of 1 year are analyzed and interpreted after comparing with another year, is known as horizontal, vertical, all of the above. What is the answer? So, horizontal analysis. Next. Financial statement of the single areas analysis is called vertical analysis. Understood? Horizontal year 1, year 2 we can compare horizontal. Vertical clear? P&L balance sheet 1 year information we can analyze. Now got the information or not? This analysis is useful for interfirm comparison. Horizontal, vertical, all of the above. So for interfirm comparison, we can use what? Vertical. Yes. Refer our book. Difference between horizontal analysis and vertical analysis is there. Okay. Answer is what? Vertical analysis. This ratio is vital indicator to the lender to assess the ability of the borrower to serve the loan in relation to timely repayment, debt service ratio, capital gearing ratio, debt equity ratio, debt service coverage ratio. Desirable debt service coverage ratio is 1:1, 2:1, 1.5:1. 2:1. Good. This ratio shows whether the business is earning sufficient profit to pay out only the interest charges, but also due to principal payment, due on the principal amount. Debt service ratio, capital gearing ratio, debt equity ratio. Again, debt service coverage ratio. Debt service coverage ratio is equal to earnings available for the debt service divided by interest, earnings available for the debt service divided by principal, earnings available for the debt service divided by interest and principal. Both interest and principal denominator. Good comment. So what is the formula for debt service coverage ratio? Repeat once again. Next. Earnings available for the debt service is equal to profit after tax and depreciation, profit after tax and depreciation plus interest on loan, profit after tax plus depreciation plus interest on loan and principal amount, including interest on. Okay. Next. Share capital plus resource and surplus is equal to equity, net worth, promoters fund, capital block, called net worth. Share capital plus preference share capital is equal to equity, net worth, promoters fund, share capital plus preference share capital. Okay. Equity, share capital, equity share capital plus preference share capital is equal to equity, net worth, promoters fund, and capital block. Called what? Promoters fund. What is it called? You can refer our packet size book. Chart. Or in ratio analysis, I went on chart also in book. Called promoters fund. Chart. Equity share capital plus resource and surplus plus preference share capital plus long-term loan plus debenture is equal to equity, net worth, promoters fund, and capital block. Capital block. Capital block represents total capital employed is called capital block. Block of total assets. Same, capital block means total capital. It consists of equity share capital, preferred share capital, long-term loans, including debentures. Understood? Capital, next question. Capital block is equal to total asset minus current liability, promoters fund plus long-term debt, net worth plus preference share capital plus long-term debt, all of the above. Answer is, what is called capital block? Capital employed is called capital block. Total asset minus current liability is equal to what? Yesterday we did one problem also. Total asset minus current liability is equal to what? Total asset minus current liability is equal to what? Total asset is equal to total liability. Total liability minus current liability is equal to what? Capital employed. Fit for nothing. Asset side fixed asset, current asset. Liability side capital employed and current liability. Upper total asset equal to total liability. Total liability remove current liability. Balance is equal to what? Very difficult to visualize. Interest lama upon second, A is correct or not? Yes. It's a capital employed only. B, promoters fund plus long-term fund, right or not? Hello? Yes. What is called promoters fund? Shareholders fund. Plus long-term fund is equal to what? Capital block only. Net worth plus preference share capital plus long-term, right or not? Share capital plus reserves and surplus is equal to net worth. Net worth plus preference share capital is equal to promoters fund. Plus long-term debt is equal to capital employed. Therefore, all of the above. Question. Think after this question, balance sheet number. Even if you don't know financial management, even if you don't know ratio analysis, from +1, +2 onwards, you're doing balance sheet. Is the current asset, is the current liability, what is capital employed? In the common logic is supposed to have. Understood? Further, you have to increase your focus. So the answer is what? All of the above. In ratio, which terminology, which reverse work will be there, we don't know. So you should know all the tricks. We did one problem. Fixed asset to net worth is equal to 0.8. Fixed asset was not given. Net worth also not given. How to identify? So net worth is equal to share capital plus reserves and surplus. Reverse work. Next. Capital block is equal to again capital employed, earning equity share capital, promoter proprietary fund. Capital employed. Ratio of net asset to net working capital is profitability ratio, liquidity ratio, current ratio, working capital turnover ratio. Ratio of net sales to working capital is called what? Working capital ratio. Turnover na sales, working capital. They are comparing net working capital and sales nothing but turnover. Therefore, what is the ratio? Without study, you can tell the answer. Okay, see exam accident. Net, that is working capital turnover ratio. Next, long-term solvency is indicated by debt by equity ratio, nothing but debt equity ratio, current ratio, operating ratio, net profit ratio. Debt to equity ratio. Okay. Ratio of net profit before interest and tax to sale is gross profit ratio, net profit ratio, operating profit ratio, interest coverage ratio. Net profit before interest and tax to sale is called before interest and tax. Admin selling expense. Gross profit admin selling expense will be there? No. Therefore, operating profit ratio. P&L sales, purchase, simple gross profit. Gross profit is brought down. Admin expenses, selling and distribution expenses, interest expenses, tax, net profit. Net profit, they are removing tax, they are removing, adjusting interest. Remaining in gross profit varo. Kidney use one. Next palama. Hello. Muruha. இந்த பசங்களை எப்படியாவது பாஸ் பண்ண வைப்பா. நீ அதை பண்ணாதான் உண்டு, அதுங்களாம் பாஸ் பண்ணும்போது தோணுது. Next, observing changes in the financial variable across the year is vertical analysis, horizontal analysis, perform analysis, industrial analysis. இதுல ஏதாவது தப்பு பண்ணு கையாளத்துக்கு தொங்க விட்டுருவாங்க. Horizontal analysis உயிர் படைச்சு. Good. The receivable turnover ratio helps management to managing resources, managing inventory, managing customer relationship, managing working capital. Managing working capital. Next column. Which of the following is liquidity ratio? Equity ratio, proprietary ratio, net working capital, capital gearing ratio. Again, you no need to order. Strong in the concept. You can understand by way of common sense. Liquidity is a long term or short term? Short term. Answer equity, long term or short term? Long term. Proprietary fund, long term. Capital gearing, long term. அப்ப எது ஷார்ட் டர்ம்ல இருக்கு? ஆட சோழ மண்டல அதுக்கு இவ்வளவு யோசிக்கிறேன். திருஷ்டி படுத்துச்சு நினைக்கிறேன். எல்லாம் செலிப்ரேஷன் மூட்ல இருக்குடி, இன்னும் தெரியல. ஹேங் ஓவர்ல இருக்கலாம். அப்படியே கண்ண மூடி விட்ட ரிசல்ட் நினைச்சுக்கோ. ஃப்ரெஷ் ஆயிடும். வந்த ஜுரம் எல்லாம் போடும். Which of the following is not a part of quick assets? இதுல தப்பு பண்ண உதவாங்க. Disposable investment, receivable, cash and cash equivalent, prepaid expenses. Prepaid expenses. கர்த்தரே அவளை மண்ணி அந்த பாவியை ரட்சிப்பாயா. அப்பா சொல்றது சவுண்டா இருக்குது. கேபிட்டல் கேரிங் ரேஷியோ is a friction of preference share capital and debentures to equity share capital and reserves and surplus. B, equity share capital and reserves and surplus to preference share capital and debentures. C, equity share capital to total asset. D, total asset to equity share capital. எல்லாமே ரைட் மாதிரி தோணுமா இப்ப? அது ரைட் ஆன்சர். The answer is A. Preference share capital to equity share capital and what? Reserves and surplus. Muruha. Next. From the following information, find, calculate price earning ratio. What is the formula for price earning ratio? Enappa? Earnings available to market price earning ratio, market price per share divided by earning per share. Yeah. So equity share capital rupees 10 each, 8 lakhs. 9% preference shares 10 each, 3 lakhs. Profit after tax 38%, 2,67,000. Depreciation 67,000. Market price per share 48. Market price per share 48 rupees 48. Okay. Based on that, we have to compute price earning ratio. Formula for price earning ratio: market price per share MPS divided by EPS. So MPS given in this question 48 divided by EPS. You have to compute EPS only. with respect to EPS, available data and net profit is there. How much net profit? Net profit after tax is how much? 2,60,000. Less preference dividend is equal to earnings available to equity shareholders. Preference dividend is how much? 10% on 30,000, 3 lakhs is equal to, sorry, 9% on 3 lakhs is equal to 27,000. Therefore, 2,67,000 minus 27,000 is equal to 2 lakh 40,000 divided by number of shares 80,000. Clear? Therefore, EPS 3. So 40 divided by 3 is equal to MPS. Answer anappa 16 times. Are you able to follow? Good. Next. Equity multiplier allows the investor to see what portion of interest on debt can be covered from earnings available to equity shareholders. How many times preference shares interest be paid from earnings available to equity shareholders. C, what portion of return on equity is result of debt. And D, how many times equity share is multiplied to get value of debt. So, what is the right answer? The answer is, what portion of return on equity is the result of debt? Answer C. Yes. Then. A company, next question. A company has average account receivable of rupees 10 lakhs and annual credit sales of rupees 60 lakhs. Its average collection period is how much? What is the formula for average collection period? 365 divided by debtors turnover ratio. So you have to compute debtors turnover ratio. What is the formula for debtors turnover ratio? Credit sales divided by average debtors. Credit sales, we have to assume all the sales made under credit. Right? Credit sales given in this question. How much? 60 lakhs divided by average debtors 10 lakhs. Therefore, 6. Yeah. Then 365 divided by 6 is equal to 60.88. Here the answer. Yes. Answer A. A is answer. Next. A company has a net profit margin of 5% on total sales of 9 lakhs and return on asset of 9%. Its total asset turnover ratio would be how much? What is the formula for asset turnover ratio? Total asset divided by turnover divided by total asset. Turnover nothing but sales. How much the sales? Net profit margin 5%. Total asset 9 lakhs. Return on asset 9%. Listen here. Total asset 9 lakhs. Return on asset is how much? 9%. 9 lakhs into 9% is equal to how much? 81,000 net profit. Clear? 81,000 net profit is equal to how much percentage? 5%. Upper total sales all of that. That's logic or not? So 9 lakhs into 9% is equal to net profit in rupees divided by net profit percentage 5% is equal to how much? Kanna? No, this is the answer. 16 lakhs 20,000. 16 lakh 20,000 divided by assets 9 lakhs is equal to 1.8. Okay, 1.8. Are you comfortable? 16 lakh 20,000 divided by 9 lakhs. Any difficulty? C is the correct answer. Reverse by way of calculator, you have to compute in exam based on the available data. Okay. Next, what does quick ratio measures? Relationship between market value and book value per equity shares, portion of profit available per equity shares, overall earnings on average total assets, market value of equity as well as debt in comparison to all assets in the replacement cost. What is the right answer? Market value of equity as well as debt in comparison to all assets in the replacement cost is called Q. Next. Calculate operating expenses. We did the problem just now, right? Operating expenses. Calculate operating expenses from the following given information given below. Sales 75 lakhs, rate of income tax 50%, net profit to sales 5%, cost of goods sold 39 lakh, 32 lakh 90,000, interest on debenture 60,000. Archana has to tell the answer. Correct. Operating expenses how much? Quick, right? Over. Then put it calculate. क्या हुआ? May I help you? Okay. P&L மாதிரி டிராஃப்ட் பண்ணிக்க workingல. Credit side sales எவ்வளவு போட்டுக்கோம்? Triple X credit. How many lakhs? 75 lakhs sales credit side. இல்லையா கண்ணா? Cost of goods sold எவ்வளவு? Debit sideல.
32 lakhs.
Cost of goods sold comes to 32 lakhs 9,000. Therefore GP எவ்வளவு? Gross profit 75 lakhs minus 32 lakhs. 42 lakh 10,000. இல்லையா கண்ணா? GP brought down. Am I right? கீழே கொண்டு வா. 42 lakhs 10,000. 10. So GP brought down. Okay, brought down 42 lakh 10,000. Potuko. Debit side, net profit how much gonna? Net profit 3.3 lakh 75,000. Interest all of them 60,000. Tax 50% tax all over same 3.75. Am I right? After tax net profit 3.75. Upper balance tax all over balance amount. Tax also 3.75. Are you able to follow or not? 3.75 is a tax also. Therefore 42.10 minus 3.75 net profit minus 3.75 tax minus interest 60,000. Balance equal to operating expenses. Net profit will not form part of operating expenses. Next, tax is not form part of operating expenses. Interest finance expenses. And remove balance equal to what? எவ்வளவு வருது? 34 lakhs. புரிஞ்சுதா கண்ணா? புரிஞ்சுதா? சேச்சி புரிஞ்சுதா? Next. Which of the following is not a proprietary ratio? Price earning ratio, sorry, profitability ratio, price earning ratio, return on capital employed, Q ratio, and preferred dividend coverage ratio. What is not to kegram? Okay. Everything profit is there, whereas D, preferred dividend coverage ratio, is not a profitability ratio. So answer D. Done. That's all. Good. And compared to other topic, ratio, your performance in ratio is poor. You understood because of yesterday's celebration, not studied properly. Impact if you are not studying properly, marnal impact there. Cumulative, if you are not going to study properly, impact will be there in the main exam. So please be careful. Because you are not revised properly. Examination continues. Daily basis, as if examination, your preparation should be there. Hello? Whatever the activities you are doing now, everything at the cost of your examination result. And the 6 months அடமான வச்சிட்டு இந்த படத்துக்கு போலாமா இங்க என்ஜாய் பண்ணலாமான்னு யோசிச்சுக்கோ. எது முக்கியம் இதான் திரும்ப. Because it is your life. This attempt should be your last attempt.